What is a forward contract and how is it different from a futures contract? Let's break this myth about the differences between futures and forwards contracts. I'm your learning partner Sushila Hariharan. If you're interested in a career in investment banking, global financial markets, and fund accounting, do subscribe to my YouTube channel where we provide content centric, research focused videos on these topics. As we understand in most markets in the world, there are two separate segments. The first one is the cash segment, also called as the spot market in some countries, and in others, there is a derivative segment. A derivative is a financial contract whose price is derived from the price of the underlying asset. So typically most derivative formula will take into consideration what is the spot price. They add the premium or the discount, which basically represents the cost of capital, and then they arrive at the derivative price. The most frequently traded derivatives are classified into two separate categories. The first one is whether it is a exchange traded product or whether it's an OTC derivative. An exchange traded derivative is classically the futures contract. A futures contract is a contract to buy or sell the underlying asset at a predetermined price for a settlement that's going to take place sometime in the future. This is decided by the stock exchange in terms of the settlement date. So the contract can take place at any point of time today, tomorrow being Saturday, no, but on Monday to Friday, and the settlement can take place at a specified contractual date. The futures contract is a separately traded contract and it is different from the spot contract. So, what is a futures contract? A futures contract is an exchange traded derivative which is entered into by traders, arbitrageurs, speculators to lock in the price of the asset for a future date. As we already know, in the spot market, the settlement will take place on a T+1 rolling settlement basis. But in the case of the futures market, the futures contract will be traded and settled will be traded today but settled at a future date. This is providing a great benefit to the traders because they're able to achieve a price lock-in. The futures price is determined by the spot price plus the interest cost for that intervening period. So, therefore, if the cost of capital is high, the futures contract is traded at a premium compared to the spot price. So, you often find that if the spot price is, let's say, 100 rupees, the futures price of the same underlying asset but a different contract could be 105 rupees. This means that the cost of interest or capital cost for holding on to that futures contract for that intervening period is 5 rupees more. Okay, sometimes the futures price can be at a discount to the spot price as well. Alright, for example, if the spot price is 100, then the futures price could be, let's say, 95. This means that the cost of interest for that particular asset in the future is negative. Therefore, the futures price is quoted at a discount to the spot price, and this happened extensively across commodities. If you recall, way back during the lockdown years of 2020, especially when nickel futures, copper futures were all traded at a severe discount compared to the spot price. So, thus, the futures price can be at a premium to the spot price or at a discount to the spot price, and futures contracts are all exchange traded contracts. Then what is a forward contract? A forward contract is a contract between the buyer and the seller to exchange particular asset for currency, the price of which is determined today, but the settlement of which takes place sometime in the future. The fact of the matter is the forward contract is an OTC derivative. That means an over-the-counter derivative. If it's an over-the-counter product, we understand that there can be significant amount of customization as opposed to futures contracts which are very standardized and released by the stock exchange. The forward contract, being OTC in nature, takes into consideration the requirements of both the counterparties to the trade. These trades are largely bilateral in nature, and because of this level of customization with reference to the quantity, settlement date, all these make the forward contract a very niche product. The futures contract, on the other hand, is meant for the large volume trades, and therefore the liquidity in the case of futures contracts is very high because there's a significant amount of volume trading that takes place in the futures segment. Literally, futures can be traded and settled on the same working day, because the settlement date, as mentioned by the stock exchanges, is the date by which the contract has to be settled, not the date on which it has to be settled. The forward contract also offers this, except that the forward contract, because it's customized, it's so specialized, it is designed to meet the requirements of the counterparties, will not have any kind of standardization, and therefore it suffers from a significant amount of illiquidity. OTC derivatives are meant for savvy investors, are meant for investors who understand risk management because of the high degree of customization that there is. If you can recall, there are non-deliverable forwards which hedge funds extensively participate in and trade in, especially in FX NDFs, because they are not able to take advantage of many of the currency movements due to the capital conversion regulations that some of the countries have. So, forward contracts and futures contracts aim at providing price protection to the trader. The only difference between forward contracts and futures contracts is forward contracts are OTC in nature, whereas futures contracts are exchange traded, and therefore forward contracts offer very little standardization. They're highly customized, they're well designed to meet the requirements of both the counterparties, whereas futures contracts are very standardized contracts. They are traded on exchanges, so there is a high level of centralized trading, which represents that there is high amount of volume traded and very good liquidity in them. That, my friends, is the only difference between forwards and futures.